Hello and welcome back to the ROI podcast, the podcast that's obsessed with the art and science of return on investment. And he's back, everyone's favorite guest on this channel, Mr. Rick Rule. Today we're going to be talking about the Natural Resource Symposium. You have sent in your questions. I'm going to ask them. We're going to cover everything from silver, platinum group metals, copper, and a few of the miscellaneous audience questions surrounding company specifics at the end. Guys, quick disclaimer, nothing that we say is necessarily advice or to be construed as advice. Do your own due diligence. And with that, Rick, it is my pleasure to welcome you back to the channel. How are you doing, sir? And what's been happening?
I'm doing very well, Benjamin. The better for being on your show. Thank you.
Thank you. You're far too kind. Now, you have the Rule Symposium on Natural Resource Investing coming up. I am personally registered, so I'm very excited. If you're interested, guys, the link will be in the description. Perhaps give us a 2-minute synopsis on what I'm going to learn by attending the conference, albeit via live stream online from my ex-colony of a home down here.
Well, regardless of whether you attend in person or via live stream, the first thing to know is that we're going to give you about 60 hours of very intensive programming in 4 days, which is more than you can absorb. So we will tape all of the proceedings, including the breakout sessions, and those will be available for live and live stream subscribers through the balance of 2024. And you'll need to consult them. I put on the conference, and I'll have to replay the tapes just to get all of what's there. So what's there? Well, we have a great cast of big picture thinkers, first of all, the global macro guys, the Jim Rickards, the Daniela DiMartino Booths, the Grant Williams, the Nomi Prinz, people who tell you about the world the way it is, not the way that CNBC or the CBC would have you believe it is. People really from the belly of the beast. Jim Rickards talking about, the financial services structure. He was the ex-chief counsel of long-term capital management. He damn near brought down the global financial structure. Talk about a guy who speaks from the belly of the beast. After we've done that, after we've disabused you of some of your commonly held notions, we have a group of analysts and portfolio managers who have made money in natural resources, where the rubber meets the road, for decades. Not people who are suddenly Twitter experts about natural resources, but rather people who have operated successfully in the trenches for 3 decades or more. My favorite part of the program is the living legends. We have 5 or more people who have built multi-billion-dollar mining companies or oil and gas companies from scratch, talking about how they did it and what lessons they learned, telling you step by step how to identify the $5 or $10 million market cap company that could become a $5 billion market cap company. Not from some newsletter writer who used to sell cars, but rather from an entrepreneur who built a major mining company from scratch. Finally, it's important, because our customers tell us it's important, that all of our exhibitors aren't just advertisers, they're content too. Specifically, any exhibitor that comes with us has to be owned and managed by ourselves. That means that every single exhibitor is vetted. At every other investment conference I know, the qualification to be an exhibitor is a check that cashes. That's it. At our conference, they have to have cashed my check, which is a very different level of vetting from my point of view. And the upshot of all that is that we've put on this conference for 28 years. We are confident enough in our programming that whether you attend live or live stream, if you don't feel for any reason that the product is worth what we charged you, email me and I'll give you a no questions asked full refund. The financial risk is all mine. There is no other investment conference, or for that matter, investor educational product that I know of on the planet that has an ironclad money-back guarantee. But our conference does. Whether you attend live or via live stream, the offer remains.
There it is, guys. Can't get much better than that. And once again, a link will be in the description. I'm registered and I'm very excited to be attending. Now, Rick, at the end of last year, a mutual friend of ours and I, Daryl Thomas, had a conversation, and Daryl was asking me what I thought might be due for an upswing in 2024. And I said, look, you know, silver just seems to be forgotten. The supplies, as far as I can work out, which is not easy, continue to dwindle. I think silver has a shot of a rebound. And he said, I'm over silver. I've had enough. Like, it's just, this is supposed to have been happening for a few years and it hasn't happened. And I said, yes, but Dazza, if Rick was here, he'd say that's exactly why we should be looking at silver. And fast forward 6 months or so, and the silver price seems to be doing fairly well. How far can the silver rally continue? And are the equities reflecting that in their pricing, in your opinion, currently?
Three comments. In my own experience, precious metals bull markets need to be led by gold. The primary buyer is the fear buyer, and the momentum has to be established by gold before the greed buyer comes into the market. That condition precedent, strong gold price performance, is something we've seen in the last 2 years. What attracted me to silver is the same thing that attracted you to it, which is to say hate, and that which didn't attract Daryl. There is no hate, Benjamin, as sincere as the hate of a jilted lover. And in the silver business, you had this whole class of young aficionados associated with the Reddit silver squeeze that were disappointed. And they experienced profound hatred, which I love to see. What you've seen in the silver price and in the silver equities isn't so much a bull market as a dead cat bounce, a rebound from a stupidly oversold circumstance. From that point, I think silver can go higher. There are those who equate the silver market today with the uranium market of 2023. But that isn't true. I don't think that we have seen an uptick in interest in silver so much as we have seen merely a reduction in hatred. Will that occur in a time frame quick enough to attract either your listeners or Daryl back to the fight? I don't know that. It might take a year, it might take 2 years. But what attracts me to silver, based on my experience in the market, has been the quantum of the potential upside. When I cut my teeth in this business, Benjamin, in the 1970s, let me give you a truly odd stat. First of all, the silver price went from $1.50 to $50. Okay, this is not a typo. $1.50 to $50. Chart it, 1970, 1980, $1.50 to $50. But a couple silver stocks made that look silly. Sadly, I didn't own them. I was too young and too dumb. But I watched Coeur d'Alene silver go from 10 cents to $65. That's the kind of quantum I'm talking about. Now I get to personalize it. In the early part of the decade of the 90s, the silver price did pretty well too, coming back from hatred. It had fallen from $50 all the way back to $4. So you can imagine that the hatred was profound. Two silver stocks that I was intimately involved with, one Silver Standard Resources, the other Pan American, went respectively over 6 years from 76 cents to $45, not a typo. The other Pan American silver went from 50 cents to somewhere in excess of $40. So when people ask me the question, if they allow the artist in me to use the word could, I can paint a truly dramatic picture. Will that performance be repeated in that quantum? Probably not. You're starting from 30, not from 4. Do you need that quantum to get excited? I don't think so. Audiences that haven't experienced a real precious metals bull market don't understand the quantum that's popular. Again, drawing back to the decade 2000 to 2010, the gold price moved from what, $256 to $1,900? The silver price itself was up 6-fold or 7-fold. So it isn't the move from $29 to $31 that excites me. It's the potential for a quantum move, a move in the nature of the 2000 to 2010 market that excites me. Is this a certainty which you can invest in? Of course not. This is a contingency that you can speculate on. But for money where you are patient, tenacious, tolerant of volatility, and in search of quantum gain, and I mean quantum gain. This is a wonderful place to be.
Absolutely. And I've heard you mention in other interviews before that you've stated that your silver stocks might double or triple before anyone even cares. It sounds like not enough people still are caring about the longer term secular move that's potentially in the silver market. What about for people that don't necessarily have that same tolerance for volatility, but still want to appreciate some of that upside? The way that I like to do that is to take a look at the royalty and streaming companies. So
Yep.
something like a Wheaton Precious Metals to me still seems criminally underappreciated, given that they can get potentially those gold equivalent ounces over 800,000 within 2 years. Obviously, people look, they just do a quantum search and they say, oh, but I've got to pay 20, 25, 30 times the current free cash flow, so I'm not interested. I think that's a little short-sighted given the fact that you do have upside to the both the rising volume in a bull market and the rising prices. The question is, what's a decent price to free cash to pay currently for a royalty or streaming business in the case of Wheaton of that particular size and quality?
If you don't believe in increased metals prices, I would suggest that Wheaton is fully priced. What people forget about Wheaton and Franco, for that matter, the other royalty and streaming companies, particularly the ones like Wheaton and Franco that have very large deposits, is that very large deposits always give you surprises, exploration surprises, and they're always positive. So what you see is not what you get. You get more. That's why I say that even at current prices, they aren't dramatically overpriced, because what will happen is that when people do a net present value calculation on Wheaton, the terminal value will be achieved in 8 or 9 years. After 8 or 9 years, you run the net present value and it resets back to where it started. In other words, the tail is worth as much as the quantum. And in order to do this, when the operator sends out the CapEx bill, Wheaton doesn't get one. When they send out the operating expense bill, Wheaton doesn't get one. Above the purchase price, their gross is their net, which is a very, very nice margin. Being able to participate in exploration upside, commodity price upside without participating in the escalation of cost is truly having your cake and eating it too. In addition, in the case of both of the big royalty and streaming companies, not operating mines is cheaper than operating mines. So the general and administrative expense is farcically lower than it is with the big operating companies. You walk through Franco-Nevada as an example. The last time I did it, the total employee count, including receptionists, was 31. You walk through Newmont, believe me, you get a much, much, much larger number. So I think that's attractive. And I think actually you'd be remiss in not talking about Wheaton River in the context of one of your own old specialties, which is either put selling or put and call spreads. If you have a predisposition in your mind to be bullish around Wheaton at these prices, the idea that you can sell a below market put while perhaps simultaneously selling an above market call does a couple interesting things. First of all, it pays you if you fail, which is to say, if the stock is neither put to you or called from you, you just grab the premium and drive on. If you do fail, then life is good. If you thought Wheaton was worth X and somebody is paying you for the right to make you buy it for 85% of X, in effect, you're being paid to buy low and sell high, which is something that you ought to do otherwise for free. To be paid to do something that you would otherwise want to do for free is very pleasant. Now, your listeners need to know from an old man that when the market conditions are such that it gets put to you, you're actually a little unnerved because the existing position that you had is down, and the last thing you want is more. Similarly, when it gets called from you, you have this odd sensation of fear of missing out. You owned a position that was doing well and somebody pulled it away from you. What I've learned over 35 years of employing that strategy myself is that while it can be psychologically difficult, it's invariably financially rewarding over time. Remember when it happens to you that being paid to buy low and sell high is a very virtuous set of circumstances.
You are speaking my language and did all the work for me. So shameless plug, the link to my newsletter where I share my options income trading will be also in the description. Couldn't have said it better myself. People always want to know. So I try and steer my followers at least in the direction of quality because I think it's an inflation beneficiary, something like a Wheaton asset light, with still an upside to a commodities thesis. But people always want to know about the producers. So I've got some questions in regarding mag, silver. Wondering if I can get your thoughts on mag before we move on to the next topic.
I own some. It has obviously performed fairly well. So people who enter it need to exercise more caution than I had to exercise to go into it. It's a very, very high quality deposit. And off to the southwest, there is a wonderful energy source, sort of a center, if you will, that I think gives them a lot more exploration upside than they're given credit for. The risk that you have in mag, I guess, is twofold. The first is that the operator of the deposit, Fresnillo and ultimately Peñoles, are very poorly thought of by the incoming president of Mexico. She regards these old Mexican mining families, these caciques, as enemies. And I think that the regulatory climate that mining in general, but Peñoles and Fresnillo in particular, are going to enjoy, if that's the right phrase, going forward will be somewhat less benign. So investors need to pay attention to that. I think, too, that Fresnillo would like to own MAG, and they would like to pay less rather than more. You'll remember some years ago that they tried to take under a very unique acquisition strategy where they tried to pay holders less than market. They were unsuccessful. They believed that other companies wouldn't want to be a minority shareholder in a deposit owned by them. They learned very quickly that Wheaton Precious, among others, and Pan American, were happy to be minority shareholders in a deposit like that, and the market exerted its will. But I think those are the two things that you need to be worried about: a partner that's not necessarily friendly, and a government that's guaranteed to be unfriendly.
Yeah, definitely do your own diligence on that one. Moving on to what I perceive is a very hated sector at the moment, or at least I think price is an indicator of sentiment only in this case. We're talking about the platinum group metals. People want to know about them. And it's interesting. The commentary from Horizon Kinetics, I read every quarter they put out. I find it fascinating. Murray Stahl's view on what actually ended inflation in 82, although Volcker got the credit, he's quick to point out a dumping of inventory on the market gave a lot of supply relief. And that was obviously from the breakup or the cracks forming in the Soviet Union. You've mentioned that you think a lot of Russian selling is leading to the current depressed price levels, particularly in platinum and palladium. And how long, roughly, do you think something like that can continue before the market dynamics start to absorb it and we get to a point where we realize what has happened, shall we say?
Sadly, Mr. Putin hasn't called me. So in terms of understanding the level of their inventory, I don't know. It ended last time when they ran out of metal. In other words, their selling stopped when they ran out of metal. The Russians need money, and the Russians will sell potash and nickel and platinum group metals as long as they have any on the cupboard. What will happen after they run out is that you will find that they haven't made sustaining capital investments, and they won't be able to maintain production of those mines until they resume the sustaining capital investment. So the snapback, I think, will be pretty dramatic. The other thing, a question you didn't ask, but I'm going to answer it anyway, is that a lot of the malaise in investor sentiment around platinum and palladium comes because its principal fabrication use is in autocatalysts. And a lot of the big thinkers of the world, that noted metallurgist, what's her name, Greta Thunberg, President Biden, Prime Minister Trudeau, the big thinkers, they've said that the end of the era of the internal combustion engine is on us. Well, if that's true, there isn't much need for autocatalysts, is there? The problem is it isn't true. The end of the epoch of the internal combustion engine probably comes at 2060, which is to say you need to do a net present value calculation over 40 years, not 4. And that is a really interesting conundrum. Oh, and there's 2 other things that make it more interesting. The first is that demand as an autocatalyst for platinum and palladium is price insensitive. It takes about $100 worth of platinum to put in a catalytic converter that enables the sale of a $50,000 or $60,000 car. If the price of platinum were to double, it wouldn't change the lot price of that car. It would not change it. Unless you see a bunch of students protesting, demanding more smog, which I think is highly unlikely, what you have is a price insensitive commodity where the production of that commodity is concentrated in South Africa, Zimbabwe, and Russia. The possibility of a supply disruption in one of those 3 countries, while not certain, is something to pay attention to. South Africa is a basket case that's deteriorating. Zimbabwe aspires to be a basket case. Russia, among the 3, is a paragon of stability. But one could see a circumstance where Russia is even less stable than it is today. I'm not saying any of this is going to happen. But if it did happen, I think that you would see a double of the platinum and palladium prices as a start because of the price insensitivity or inelasticity to demand. Very, very interesting circumstance.
Indeed, it is. There are some similarities that I draw between the cost as a percentage of the auto manufacturing and uranium as a percentage of nuclear reactor supply. So there really are.
Same equation. Same equation. Exactly the same equation.
It's very interesting.
I mean, there will be a price where fabricators learn to fabricate more efficiently, where palladium gets substituted for platinum or vice versa. Ultimately, perhaps in industrial scale catalysts, they begin to substitute nickel for platinum or palladium. In other words, they use a metal that's much less efficient, but also much cheaper. But the headroom between here and there is really, really, really vast.
Yeah, and it's not as if you can flick a light switch and have an instantaneous response. That will take some time to play out. Those 3 places, Russia, Zimbabwe, South Africa, I mean, 82% of the mined platinum supply from South Africa and Zimbabwe combined, 43% of the palladium, and 87% of the rhodium. We recently had elections in South Africa. Some people say that might be a slight turn in the right direction. Are you active in South African assets? Because, as you mentioned, there really aren't that many ways to get access to this thesis.
You know, I'm a glutton for punishment. South Africa's treated me well on and off for, I don't know, 45 years. I love the place. I love most of the people. Most of the people. But it's getting worse. You are always flirting with problems in South Africa. Looking at platinum and palladium in particular, the ruling party, at least right now, the ANC, has been disturbingly vague about who will own the mining business in South Africa 10 years from now. Whether they will steal it by way of nationalization, as the EFF prefers, or whether they'll steal it in slow motion fashion via social rents, taxation, and stuff like that. The consequence of this uncertainty as to tenor has meant that the major platinum mining companies have not invested in technology or sustaining capital. They've substituted labor for capital. The labor is unskilled labor. It doesn't operate much capital, so you can't pay very much for that labor. You're in an odd place in South Africa where the wages have to go up, but they can't. The miners are between a rock and a hard spot. The social unrest around that has exploded twice in my lifetime into massive violence on the Platte Reef. You know, if you have a circumstance where people need to get paid more and they can't be paid more, this is a truly ugly conundrum. And I think that people who speculate in platinum and palladium have to understand that. It means, among other things, that in the large South African producers, which have lots of leverage to the upside, they have leverage to the downside too, in terms of production disruption. I don't own Anglo Plats. I don't own Sibanye-Stillwater, despite the fact that I'm personal friends with the CEO. I do own Ivanhoe, which at some point in time is going to build a platinum mine in South Africa, a very different one from scratch, highly mechanized, paying by South African standards extravagant wages, which means that they have their pick of the labor pool. But in terms of my own current participation, I own the Sprott Physical Platinum and Palladium Trust, partly because I trust my former employee to safeguard my material. And I own exploration and development stage projects outside of South Africa, Russia, and Zimbabwe. I own them on the speculation that a supply disruption in those countries might occur. If it did occur, top quality assets outside of those countries, I think would benefit both from the price appreciation of the material, but also because of the strategic value of alternative sources of supply for original equipment manufacturers. I would note that JOCMEC, the Japanese consortium supported by the Japanese government and the automakers, bought 10% of Ivanhoe's project, the Platte Reef, for $200 million, valuing the deposit as a whole at $2 billion, when it is still 3 or 4 years at best away from production. So the idea that OEM people would be looking for secure sources of a supply that's absolutely positively necessary to sell their finished products is something that investors need to consider.
Do any of these exploration and development projects outside of South Africa, Zimbabwe, and Russia have names you wish to
Have
share?
names. Funny you should ask. As an Australian, you may have heard of Chalice.
Yes, I have. Yes.
Insanely out of favor, partially because it was so much in favor 4 years ago. Again, the cure for high prices is high prices. If you are a company that's nickel-centric and platinum-centric and the price of those falls by half, you have a problem. This is a big deposit. 17 million ounces of contained PGMs and about an hour and a half outside of Perth. Being in the Perth suburbs basically means you're not in Russia or South Africa, right? There's another Australian company, but not with a project in Australia, one called Centaurus. By the way, these are all speculative, okay? We're not talking about mature producers by any stretch of the imagination. But Centaurus also has what I would consider a tier 1 world scale mafic, ultramafic, nickel, platinum, palladium project in central Brazil. And then there's a Canadian listing, Bravo, which has a third platinum, palladium, nickel discovery in Brazil. And also recently, like 12 days ago, announced a very different style of mineralization there, an iron oxide copper gold style mineralization. Very, very, very high grade copper, like 12 meters of 12%, 14%. Entirely different style of mineralization. Threw me for an absolute loop. I mean, a happy loop. But that's something, if you believe in this platinum and palladium thesis, that you should pay attention to.
Absolutely. And I will definitely be taking a look at that if you get a copper upside as well. You mentioned Sibanye-Stillwater, and this is not exactly the type of company I would normally own. But what I said to myself was, I said, look, what if I exclude all the South African assets and just wrote them off to zero? What do I think is let's say a 20% in situ value of their resources outside of that jurisdiction? And I still think that even at a very rough back of the envelope, it's trading at like that resource would be worth multiples of the current market cap or enterprise value. Do you have any thoughts about Sibanye-Stillwater's external assets, shall we call them?
They have done a wonderful job managing Stillwater. The prior managers of Stillwater operated that mine for Wall Street, and as a consequence, underinvested in sustaining capital, and as a consequence of that, ran a very unsafe mine where miners died. Miners' families don't like that. Neil Froneman came in, did what he had to do. He, took the upfront hit to reduce production and increase sustaining capital investment. And that mine's running like a top now. He's a top quality guy. And there's a lot to what you say. My belief is that if South Africa experiences the type of social turmoil that I think is likely, that irrespective of the facts surrounding the Stillwater complex assets and the other assets of Sibanye-Stillwater, that the stock will still get hurt because of its South African association. And then I'll have the opportunity to decide what I think the sum of the parts is worth in the cold light of day. I need to say, I've known Neil Froneman, the CEO, for a very, very, very long time, in excess of 30 years. There was a time when I knew him quite well. He's busy enough that, like Putin, he doesn't call me anymore. But he's a really top quality guy.
Yeah, I imagine he has his hands full there, sorting out one or two issues. Yeah, my take is that, look, the platinum and palladium, I have a long-term bull thesis. There's going to be a gut-wrenching amount of volatility, and I'm just focusing on everything outside of South Africa. Current price is roughly where they did that cap raise last year, and I think it's a good opportunity to get in at a time, same time that some of the institutional capital flows went into the stock. Rhodium is something that people don't know much about, myself included. It's included in the PGMs.
Yes.
It's had double-digit demand growth, and continues to be, as far as I can tell, in a supply deficit. The price shot up recently. It was kind of a lithium story, went to 30K and then down to 4.7K at the moment. Is Rhodium hated enough for Rick Rule to take a look at the moment?
It is hated enough. Unfortunately, those really skinny metals, really small markets, let's just say they've been reputation wreckers for me. I can't understand enough about byproduct supply to do a reasonable supply forecast. When demand takes the price up, markets work, and the price collapses. So I'm going to respectfully decline that question for fear of making myself look dumber than I actually am.
Fair enough. Fair enough. In Before we move on, in terms of portfolio construction, a lot of these are going to have volatility associated with them. That's
Yeah.
just the way of these commodity metals. How much of a portfolio can one seemingly weight towards these types of plays, the development and exploration plays that you mentioned? Perhaps if we have a high risk profile and a moderate to lower risk profile, where would you suggest people carve out a certain percentage of their portfolio? How much might that look like for each
I don't
individual?
think there's a one size fits all answer to that. I think it depends a lot on the investor. The investor's appetite for and ability to afford risk, the investor's need for current income, the investor's time frame. I mean, I understand the question. It's just in 35 years of constructing portfolios for people, I never found a one size fits all answer. I myself have constructed a portfolio for a client I know very well named Rick Rule. And that portfolio is pretty liquid, despite the fact that I know that I lose purchasing power on cash. I have a lot of cash because cash serves me well during periods where there's a liquidity squeeze. And if there is one, I would like to take advantage of it rather than being taken advantage of by it. I consider personally gold to be good cash, volatile cash, but good cash. So I have reasonable holdings of bullion. The rest of my portfolio is sort of 75% invested, which is to say in quality assets, often acquired or, if not acquired, utilizing the same put and call strategies that you talk about. I've learned over time, however inconvenient temporarily, being paid to buy low and sell high is a very good thing for one's net worth over the course of a decade. But I'm also a determined speculator. All of the money that I now invest wisely, I made by speculating wildly, all of it. And that means that if there is a circumstance out there, even where the probability of success is much less than 50%, if the juxtaposition of risk to reward is, 25, 30% on the downside and 1,000% on the upside, if I can find 10 bets like that where I can deploy reasonable sums of money, I love doing that. I absolutely, positively love doing it. So I would suggest that my portfolio is probably at least 25% speculative. Two cautions there. I'm old, fat, and rich first, right? I can financially afford to lose money speculating. I'm also very patient. You and I have discussed before that, as an example, my average 10-bagger has taken 5 or 6 years to mature. And in addition to that, has exposed me to 50 or 60% share price declines during the period I owned it. I have a very thick skin for that. Volatility doesn't bother me at all. It amuses me if I notice it. Many speculators, if they see share price drop 15%, will sell reflexively when perhaps buying is a more logical activity than selling. But I understand now, after dealing with investors for a very long time, that the optimal makeup for a speculator is uncommon.
Indeed, it is, and I personally have felt that. And to such a degree, what I've done is I've separated my options income portfolio and a long-term wealth portfolio. They're under separate accounts so that I don't get the too confused. And I think part of what allows for large gains over time, as I understand, is allowing those multi-baggers to play out. And that's a process with which you don't want to interrupt. And hence I have my income strategy on one side and I just have my longer term high conviction thesis on the other.
And the same is true for your income portfolio. What you learn is that really good companies generally get better. Buffett talked about selling, saying the biggest risk of selling is that you do something stupid with smart money. You take it out of where you made it and you put it in something unproven, and then you lose it.
Yes,
And
I've had plenty of
by the way,
so.
I've proven that thesis myself.
Yeah, I think it's an ironclad law of the universe, and you affect your portfolio gains so much if you get assigned too early writing covered calls, and you there's nothing worse than looking back and thinking, oh God, I missed out on quite a lot of upside. So that's why I separate the two.
Yep.
Rick, copper. Well, as far as I can tell, everyone understands the long-term thesis behind copper. I understood it, but I couldn't find a way that I could play it that I felt comfortable at the start of the year. And so I've sat back and missed the recent rally because I felt lost. I started then to look at iron ore because I found that iron ore and copper have a reasonable correlation, and iron ore just has less eyes on it. Can you help me identify some of the quality names in copper and where a sector tourist like myself might begin?
I think the stealth name in copper is Glencore. It's a stealth name because there's a lot of political risk around Glencore, and a lot of their free cash flow comes from coal. And the big thinkers of the world, again, tell you that the world's going to stop using coal, except it isn't. So my real stealth name in copper is Glencore. Two smaller names in copper that are still pretty big and high quality names would include Teck Corp, which gets to spend $8 or $9 billion from selling their coal assets, doing something, who knows what, perhaps buying in shares. And Lundin Mining, a much smaller company that's extraordinarily attractive by every possible metric. But an iron portfolio, a high quality iron portfolio, which is to say BHP, Rio, maybe stopping there, is also a high quality copper portfolio. The value of these tier one copper assets, I think, was very well described by the recent corporate activity in Anglo. The acquirers didn't actually want the South African assets. In order to acquire Anglo, they were going to require Anglo to sell the assets that made Anglo so that they could get access to the copper assets. the value of the copper assets ascribed by the proposed transaction exceeded the market cap of the entire company before this activity took place, which will tell you something about what freestanding copper assets are worth. The demand side of copper, I think, as you've described, is fairly well understood by people. The problems with regards to supply, I think, are less well understood. The amount of time and money that it takes to permit, finance, and build a copper mine, in other words, to impact the supply deficit, is much longer than people think. Two, on a global basis, the social rents associated with producing copper, royalties, tax, regulation, and offsite capital expenditures by mining companies has been growing at 20% compounded. On the regulatory side, and this will blow your mind, there is a wonderful copper deposit in the United States called Resolution, controlled by BHP in Rio, was discovered 30 years ago, when I looked more like you. I mean, a long time ago. And it's in a wonderful location. You know, it's next to copper mines. There's a town there where there's a bunch of guys that mine copper, right? Highways, power, roads, water, smelters, everything you could want. The deposit's been, oh, I should tell you this too. It's a big deposit, well over 1 billion tons, 1.5% copper. So more than 3 times the average mine grade worldwide. You know, goddamn bonanza. And it's been 26 years in permitting with no end in sight. Building a big copper porphyry, a Chilean porphyry, or heaven forbid, a block cave like Resolution, is a $6 billion or $7 billion or $8 billion undertaking. And it's an undertaking where you have no idea as a producer what the fiscal and regulatory regime is going to be like when you finish. So it's a very interesting circumstance that conspires to make existing long-lived assets worth much more than people think they are.
Interesting. And this is what I've looked for, is there a straightforward royalty play on this type of thing? Because I do understand it's going to take time to appreciate, and I would prefer not to participate in that compounded expenditure in the expense column that you mentioned. Do you have any royalty plays on copper, Rick?
There isn't a pure play royalty play on copper. I mean, certainly Altius has a copper stream and royalty on Chapada in Brazil, which is a high quality copper asset. But it isn't as meaningful to Altius as other aspects of the business. Interestingly, Franco-Nevada, of course, had the royalty on Cobre Panama before the Panamanian government decided to steal it. That was an interesting market lesson too. The Cobre Panama royalty comprised about 14% of the net asset value of Franco-Nevada. When the asset was stolen from them, at least temporarily, the share price declined by 42%. Simple arithmetic tells you that that was an overreaction in the market. And it was a wonderful opportunity for a long-term holder of Franco-Nevada like me to increase his position. Didn't answer you the question. It just was a wonderful platform for a statement.
No, it did in a roundabout way for sure. Glencore, there's a lot of talk that Glencore may actually spin off their coal assets in terms of this, inverted commas, ESG multiple re-rate. Right. Do you have a rating or any further comments around the companies you mentioned, Glencore, BHP, and Rio?
Because I have a willingness to take political risk, my favorite is probably Glencore. I mean, the stock has done well. Your risk there is that they're former commodity traders, and they have thus far been guilty and had to pay fines of about $2 billion around the acquisition of certain assets, acquiring them the old-fashioned way, paying preemptive and informal tax. And probably the last shoe has not fallen with regards to that. Two, there are a lot of institutional investors, including some that should know better, who won't own them because of their coal assets. I was on a phone call not too long ago with one such investor, and I asked him whether he believed that the 1 billion people on Earth with no access to electricity deserved the access that he had. um, I'll leave that sort of answer to you. The Glencore people are very smart. They have a high quality asset base, and they're penalized both because they did a smart thing, which is to say they increased their coal exposure, and because they acquired assets in a way that was not uncommon at the time that they acquired them and got caught. So if you can stomach that, it's a good way to play the copper business fairly cheaply. If you can't stomach it, you can buy great copper exposure in BHP and Rio, albeit diluted copper exposure, because the important metal to them is, as you would suggest, iron. Copper is the growth metal, but it isn't the current metal. If you want a purer play, then I think you come down the quality trail, but not too far, to Teck or Lundin mining.
Very interesting. Reminds me a lot, speaking of Glencore, the history is fascinating. Reading the book by Javier Blas, The World for Sale. It's just a truly fascinating look as to how the company was formed and the different transition phases it went through, and some of those informal and preemptive taxes that you mentioned certainly
I'll
outlined.
tell you, Benjamin, I used to compete with them in project finance. And that was decidedly unpleasant. They are very, very, very good. Now, they weren't looking at the pure play yield from project finance. They were looking to use project finance to secure offtake for their commodity business. But basically, when I say competed against them, if I wanted to print and they wanted to print, they won. That was how the competition went. It's much, much, much more pleasant to be a shareholder than to be a competitor of those guys.
Well, if you can't beat them, join them, as they say.
That's right.
Notable absence in those main names you mentioned, any of the Brazilian companies that have access to both iron ore and copper. Political environment
Vale,
seems to be more and more
Vale
challenging.
needs to settle that tailings dispute. And the current president of Brazil, Lula, is not a friend of Vale's. He's not a friend of Petrobras. The state is a big shareholder of both, and he would like to increase both taxes and dividends, which is to say he'd like to eat his cake and have it too, while at the same time causing the companies to defer or suspend the necessary sustaining capital to maintain the dividend. While Vale is very, very cheap on a cash flow basis, I think you do need to factor in the company's real culpability in the tailings collapse. That clearly was an engineering challenge. It was a preventable problem. 60, 70 people died. The other shoe falls. And then you have to deal with the greed and larceny of the president of Brazil.
Yeah, it does seem to. And if anyone's familiar with the company Braxham, the story there, those guys actually sunk a whole town, and so some of those lawsuits can take ages to play out and be very, very expensive.
Yep.
Rounding up the interview today, I want to introduce a segment. I might call it the Stock Saloon or something like that, where imagine a card table, Rick, and you and I are playing some cards, having a drink, and I throw out a name to you, and you give me maybe a one-line comment and some of your famous ratings. What I would like to start with is Blackstone Minerals. I think it's a fabulous company, and I don't see a lot of attention on this company for some reason.
I'm a Blackstone shareholder. I know their mineral estate pretty well. I actually co-own some minerals with them, so I know them very well. I have Blackstone as a 4. The price is falling reasonably rapidly now. The yield is pretty decent, so I may upgrade that one to a 3.
Indeed. And Viper Energy, ticker VNOM. To me,
Don't know enough about Viper to comment. It has changed so rapidly through M&A that given all the companies I try to keep up with, I haven't been able to keep up with them.
fair point. Origin royalties, some of the viewer questions coming to the fore now.
I'm a large Origin shareholder, so that needs to be almost a reporting shareholder. That needs to be disclosed. The stock has done very well. They have a nice producing royalty, Ermitaño, and they have a royalty the size of which will be determined in court on the great new Anglo discovery in South Nevada, the Silicon and Silicon Cap discovery. Looks like 12 million ounces plus. We don't know what that's worth yet. In addition, the company is cash flow positive in its exploration efforts through exploration fees to major mining companies. Whether or not I would try to build as large a position as I have today, with the stock having doubled in 12 or 14 months, remains to be seen. I have recently downgraded Origin, well, all the way from 3 to 5, as a consequence of the rapid share price escalation. You know, the market is now paying for the reality that was pretty evident 18 months ago when nobody cared.
Indeed, fair point. A little more obscure, one of mine, Mesabi Royalty Trust, only got one mine. Are you familiar with Mesabi?
I I won't bore you with the story. Yes, I'm familiar with Mesabi. We have Mesabi as a 5. It's an extremely stable dividend payer. Extremely stable dividend payer. My concern about Mesabi is that I prefer my base metals producers to be in the bottom cost quartile of the cost curve worldwide. Mesabi is decidedly not. It benefits from being the largest and most politically secure supplier to the U.S. Iron and steel industry. But Mesabi is not a low-cost producer, nor, frankly, a high-quality producer. They produce a pelletized iron product, but income investors probably should swallow twice and own them anyway.
Metalla Royalty, MTA.
Metalla is under review. I don't have a ranking of it currently.
Fair enough. Gold Royalties.
Gold royalty, I had degraded all the way to a 7 when it ran up so dramatically in price. The market took care of that problem. If you look at their shareholdings in other companies, the fact that they're trying to beneficiate their royalty holdings and their very large cash holdings, gold royalty has fallen or risen, pardon me, from a 7, which is a very low rating, to a 5 rating. If they and their partner company, Gold Mining Inc., are successful in beneficiating the assets that they bought very, very cheaply 10 years ago, that stock will re-rate higher.
Rather frustrating one for some, Sandstorm Royalties.
Sandstorm I have as a 5. I'm reviewing downgrading it to upgrading it, pardon me, to 4. The reason for that is that the knock is 2 things. Poor capital allocation. 4 years ago, they bought back a bunch of stock, ran out of money, and had to issue stock at a pretty strong discount to what they bought it back for. Stupid. I don't think Nolan Watson needs to be stupid twice. He's a very smart guy, fairly good friend of mine. What really attracts me is the market knock against the company for high debt. If you look at the balance sheet and the income statement over the last 4 quarters, they have been generating a ton of cash, and that debt level is falling very, very, very quickly. When Hodmodden, their Turkish asset, comes into production, I think that you'll see cash from Hodmodden go through beneficially the balance sheet of Sandstorm, very much like you'd see a pig go through a python. So I'm attracted to Sandstorm, attracted again because so many other people hate it.
Yeah, it sounds like a catalyst for re-rating. Final viewer question, which I thought was a good one and interesting. Please ask Rick why Sprott doesn't have a physical tin trust yet.
Because they haven't gotten around to it, I
Okay.
think. Their hands have been pretty busy launching ETFs, managing the growth of the uranium trust, and now launching the copper trust. I had preferred, frankly, that they offer a tin trust. But I'm no longer an officer director. I'm a shareholder. And you know, the people don't listen to shareholders. So
I don't know, I think they may listen to you as a fairly substantial shareholder, shall we say. Rick, closing remarks. I'm looking forward to joining via live stream the Symposium. Where can people contact you if they would like some of their natural resource portfolios rated and ranked, much like we have just done in the stock saloon section?
Absolutely. Go to ruleinvestmentmedia.com. List your natural resource stocks. Please no pot stocks. Please no tech stocks. Please no crypto. I'll rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues if I think my comments might have value. Once again, ruleinvestmentmedia.com.
Excellent. That sounds fantastic. Rick, thank you very much for joining me here today. Guys, wishing you all the best, and I look forward to catching up with you in another episode of the ROI podcast shortly. Take care.
Thank you, sir.